Welcome to Coffee and Crypto with Lee and Jimmie. I am Lee Reiners, joined as always by Jimmie Lenz. Jimmie, this is our second Monday episode in a row. We couldn't
and you
do
have to blame
Friday
me. You have to
because
blame me for
you
that.
were in the Big Apple speaking at a conference, right? So tell
I
us about
was. I
it.
was at Quant Vision 2026 at University there, Fordham University at the Gabelli School of Business,
Nice.
and I was really impressed with the turnout. It was nice. I mean, you're in New York. You figure a lot of people are going to show up, but we had students from like all over the place there, all wearing suits. I have to mention.
Students in suits.
All wearing suits. I mean,
What?
it wasn't a business school, so that's a little bit different than you and I usually
Yeah.
run into. But yeah, they were all wearing suits. They were all there for the
Wow.
whole day and asked some really good questions.
Were you wearing a suit?
I was not, shockingly, but I was wearing a jacket. I was wearing a shirt and
Okay. All
jacket.
right. There you
So
go. Yeah. I don't think I've ever seen you in a suit.
not my usual golf shirt. So
There you go. All right. Well, glad to hear it went well. I'm
it was good.
imagining, Jimmie, that one of the topics of conversation at the conference was the big SEC guidance that came out last week. Long awaited, right? This is something that obviously the crypto industry has been clamoring for, Jimmie, for quite a while.
Mhm.
Atkins has teased it, and we'll get into sort of what took him and the SEC so long. I have some thoughts there. But we finally have sort of a comprehensive guidance. Now, this is actually called, the technical term is interpretive guidance, right?
Right.
So this is not a
Not
formal
law,
rule.
guidance.
It's not a formal rule. I don't think the full commission actually voted on this, right? So this is guidance, so it's subject to change, of course, that really lays out under what circumstances a digital asset is a security or not a security. And the main takeaway, Jimmie, is that in the SEC's view, as well as the CFTC, because they were party to this as well, most digital assets are not securities, right?
Ah,
That is the takeaway, okay? So what does it do? It provides a coherent token taxonomy. And it categorizes tokens into multiple categories. So digital commodities, which they say are not securities,
which are not
digital
securities, they're
collectibles,
commodities.
digital collectibles, not securities,
That's
digital tools, not securities, stablecoins, not securities. Digital securities are securities. Shocker there, right?
shocking.
So if it's already a security and you put it on the blockchain, still
It's
a
still a
security.
security.
They've already said this. We knew that, right?
Yeah.
In addition, Jimmie, the commission laid out under what circumstances a non-security crypto asset can become subject to an investment contract.
Yeah.
Okay? And really, this is sort of codifying a view that has been around for a number of years, which is this notion that a token that is sold or distributed pursuant to an investment contract is not in and of itself a security or an
Right.
investment contract, right? And the analogy is to the original Howie case, right, involving orange groves, citrus
Right.
groves, right? That was part of a scheme that was an investment contract, but of course, the orange groves themselves are not securities,
Right.
right? And I have some issues with this interpretation as well. And then finally, the commission provided a little more detail on protocol mining, protocol staking, and the wrapping of non-security crypto assets, and basically saying under most situations those are not securities as well. And then airdrops do not involve an investment of money, so they're under Howie, therefore not security. So big takeaway, Jimmie, is that at least in the SEC's eyes, most digital assets are not securities. So congratulations, crypto, you got your wish list. Happy Christmas, Merry Christmas.
Was there anything here that actually surprised you, Lee?
No.
Yeah.
No, not really. I mean, these are all ideas. I've been immersed in this space for a while, as have you, and I'm obviously more on the policy side. So these are all, basically this was just copy and paste from numerous comment letters, filings over the years that the crypto industry has put forward. So these are all arguments that I have heard many times over. And again, Jimmie, I think the question is, what took Atkins so long? Because he's coming up on a year now, right? It took him a while to actually get confirmed and sworn in. But he's coming up on a year, and he's someone who obviously was deeply immersed in these issues in his prior job,
Right,
right,
his
as
prior
a
role.
consulting. So it's not as if he like needed to get up to speed. And of course, you had his fellow commissioners, Commissioner Peirce, Commissioner Ueda, who have also been at the SEC for
Yep.
quite a while, very well versed in these issues. I mean, Commissioner Peirce goes by Crypto Mom.
Yeah.
And so, what took them so long? And here's my theory. My theory is that they did not want to undermine momentum for market structure legislation, right? And I think, to me at least, the fact that they put this out there now is a recognition that that momentum has stalled, that Congress is probably unlikely to pass market structure legislation before the end of the year. And they just didn't want to wait any longer. The crypto industry didn't want to wait any longer, right? And so they finally pulled the trigger to sort of codify their view, which, by the way, Jimmie, is the exact view that is reflected in Clarity, right? So
Yeah.
this is like this is like
It's
perfect
straight
alignment
from
with
Clarity.
Clarity.
This is straight from Clarity. I mean, I take my take on it was a little bit different, but I mean, I definitely see your point. I was thinking kind of a little bit broader, maybe that they were actually waiting to come to some kind of tacit agreements with CFTC before he came out
Oh,
with
yeah,
something
that's a
like
fair
this.
point. Yeah.
And we've had both happen, right? I mean, the Clarity Act has officially stalled, I think, in particular with with elections coming up and stuff like that. The last thing on Congress' mind is this when there's election money to be raised, and and then the CFTC and the SEC have now come and done these joint press conferences, and they've agreed to agree on some things, and they've agreed to work together.
Agree to agree. Yeah.
I mean, it just seemed like maybe a confluence of both of these things. But I saw, when I saw the joint press conference and stuff like that a couple of weeks ago with the CFTC, and then this is like it was like a setup. It was going to come out something like this. But I think they were waiting for something along those lines to happen. That was my take.
Yeah. I mean, look, it certainly helps to have a confirmed chairman in place at the CFTC, which they do now. And as we talked about before, Selig, worked for Paul Atkins prior to becoming CFTC chair. And as I've joked, but with all seriousness, he still works for Chair Atkins. But anyway, yeah, but so that could be a part of it. I'll grant you that. I mean, you obviously had an acting chair at the CFTC prior, and Commissioner Pham, who was more than willing to go along with the SEC and Atkins's view on crypto issues too. So, I don't know. We'll see. I mean, I posted a comment on LinkedIn, and I'll put it in the show notes for folks who want to take a look. I actually addressed this argument, Jimmie, head on when I spoke last year, about basically a year ago. When I spoke at the very first roundtable of the Crypto Task Force. And ahead of that appearance, I submitted a very detailed written statement because I knew the direction things were heading in, and that the SEC was going to probably try to codify this view that tokens distributed pursuant to an investment contract are not themselves securities. And what I say in my post and what I said to the SEC at the time is that this analogy to the orange groves in Howey, it really falls apart when you look at it closely, because in Howey, the overwhelming majority of citrus groves owners in the U.S., right, 99.999% of people who own citrus groves, right, had nothing to do with Howey's investment scheme, right?
Right.
In crypto, by contrast, the only way to participate in the scheme is through the token, and anyone who holds the token is by default exposed to it. So that makes the token not just the subject of the investment contract, but the instrument through which the scheme operates, right? So it's the means of participation. So I've taken issue with that. And I actually looked at courts who have ruled on this issue and thought about this issue. And, and that's basically how they viewed it as well. So another reason I think the SEC has taken so long to do this is because, in my opinion at least, the law is not on their side. And so they were hesitant to do this. And I think, one sort of indication that this may be the case is that this is not a formal rule, which would be subject to adjudication under the Administrative Procedure Act, right? There's a lot more avenues for challenge. So I don't think this is by any means the end of the story. And look, if Congress doesn't act and pass Clarity, we could have a future commission under Democratic control who could easily undo this, right?
This this is one thing that, so I received questions last week, and you and you both receive questions all the time around different elements, and things that are going to stay in place, and things that could be reversed should another administration come in and have a different view on digital assets. And there are some things that can easily be reversed, and there are some things that would be almost impossible to put back in the bottle.
That's true.
And this is one because it's not even a rule. That would be fairly easy to reverse. So I would say, don't stake a lot on this, on the long-term prospects of this. However, I mean, for the next couple of years, it's probably in place. I was going to ask you, as far as clarity goes, because I have received a fair amount of questions around, is this going to move forward? What do you think is going to happen? And I really think for this Congress, it's dead. I just don't see him taking it back up. I don't see anything pressing that would force them to. And now that we're in the midst of the election cycle, which it seems to go on forever, I just think it's lost a lot of its momentum.
Yeah, I mean, this is one of those instances, Jimmie, where the crypto industry lives in its own bubble, and so sort of how they perceive the world is very different than how the world actually operates, right? Particularly when it comes to DC and politics, because this is not an issue that most voters care about, or frankly even aware of, right?
Yeah.
And they try to sort of gin up these fake polls that sort of say, oh, there's millions of these one-issue crypto voters out there, and there's just not, folks. Look at the polling methodology. Look at Pew. Right, legitimate polls. No one gives a shit. So, eventually you just run into the calendar of elections, right?
Yeah.
And having to hit the trail, other things going on, like a war, for instance. The president has said he doesn't want to pass any legislation until the SAVE Act, right, makes its way to his desk, which in my opinion is a voter suppression bill. So that's going to slow things down. And then, okay, so fine. There's reporting going on right now that Senator Tillis and Senator also Brooks from Maryland have reached some type of tentative agreement on the third-party yield, or third-party reward debate, right?
Third-party rewards,
and that's what's sort of sucked up all the oxygen over the past however many weeks, right? That's just one hurdle.
I was going to say, but that's only one factor.
That's just one hurdle.
Like the whole thing.
Yeah. So the whole conversation is like sort of centered around, well, we can figure this out. This, smooth sailing, and it is not smooth sailing, folks. And the elephant in the room that the crypto industry doesn't want to talk about because it's out of their control. There's nothing they can do about it, and it makes the whole industry look shady as hell. Is Trump's conflicts of interest in this space, right?
Yeah.
And Democrats are up in arms in this. And look, I mean, this is free consulting advice for all the listeners out there. So you can fire your consultants and fire your lobbyists here, right? Obviously, the crypto industry wants this bill to pass because it's good for their bottom line, right?
Sure.
This is just common sense, right? You're not going to, advocate for a bill that you think is not going to be good for your bottom line. President Trump is in the crypto business, folks. Okay, de facto, the bill is good for the president's bottom line. So why would any Democrat, given all the shenanigans he has pulled, and that's putting it mildly, Jimmie, okay, vote for a bill that would line Donald Trump's pockets? It's not gonna happen, folks. It's not going to happen. End of story, right? So I'm sorry.
I was questioned quite a bit last week, just last Friday, about the stablecoin payments. What I thought was going to happen in the OCC commentary period, and what was going to happen following the commentary period, how I thought things were going to go. And I said unequivocally, they're going to stop the yield. They're going to stop yield payments. I have very little doubt in my mind that is going to continue for a number of reasons. But I said, get it while you can, because it's the stablecoin yields. And what I see happening are these tokenized money market funds are going to be the beneficiaries at the end of the day, who are very traditional financial services companies, because that's basically what they are anyway. Right. The same. If you're looking for the yield, if you're looking for a quick way to get yield, this is a quick way to get yield. Can you spend them the same way? Not yet, but could you possibly? Maybe.
Nothing stopping them.
We'll
Nothing
see.
stopping it. Yeah, it could be.
But I think, you can't exchange them directly. The tokenized money market funds.
I think you can.
I don't think you
can. I think. Okay.
I don't think you can, but I don't think you can. But
you have to do it with the fund itself.
Yeah.
Okay. I think for some there's like a whitelisted, there's whitelisted wallets, and amongst the whitelisted wallets, they might be able to.
You might be able to do it. Yeah. But that would be an extra step. But anyway, I mean, if you're just looking for a place to park cash to earn a good yield until you have something to do with it, that's what's
already out there.
The tokenized money market funds, they're going to trade 24/7. Yeah. Sure, why not?
Well, and this is why I've always argued that the bank's claims are a little exaggerated because, there are yield products easily accessible already out there. But, and we'll look at the language, right? So no one's seen the language yet, right? At least the public hasn't seen the language. And I'm sure we'll talk about this on Friday when we get back to our normal schedule here, presuming we have the language then. But what I've been reading, and I'm sure you've seen it too, is that they're going to try to split the baby by saying, well, balances, just sort of idle balances can't earn rewards, but you can sort of earn rewards from transactions. Right. And, of course, that's applying a framework from card payments to the blockchain, which it doesn't map neatly, right? And the thing is those rewards that we get for using our cards, right, using our Sapphire Reserve card or our Delta Amex, whatever that, are paid for by the merchants in the form of swipe fees.
Right.
Right. So I don't know how that's going to work in the crypto context. Right. And the reality is in the US, as we've talked about many times, people aren't using stablecoins for payments, nor are they probably going to. I mean, we've always talked about the use cases and where it's happening. It's B2B, cross-border B2B,
a lot of
right?
Cross-border B2B.
Consumers in countries with, hyperinflation, capital controls. We're seeing adoption there. We're not seeing any adoption, Jimmie, here in the US amongst retail payments. So, so I just don't know how you're going to map that concept neatly into crypto. And that's going to require someone to track who's going to be the tracking? Is it going to be the stablecoin issuer? Is it going to be the exchange? Right? All these things. So I'm not sure, if the folks, it's not as if Senator Tillis is going to be aware of all these nuance here. So what I've told the bank folks is look, if it's a compromise the crypto industry is willing to agree to, it's because they've already determined how they're going to be able to game it. Right?
Yeah.
That's the reality. All right.
Well, I mean, everybody's looking at how it is going to benefit you at the end of the day. I mean, Senator Tillis has done a lot. I mean, we've both had a chance to work with the staff a little bit. Very, very capable staff. They have a lot of
top-notch
other things they're working with.
Top-notch staff, yeah. The Fed chair fight. He's holding the line on that one. God bless him.
So, I mean, it'll be interesting to see, what happens going forward. But my prediction is, stablecoin yield payments just for holding the assets, they're gone. We just don't know it yet, but I think they're gone.
Yeah, well, it's an epic battle, and it's interesting to watch for sure. I mean, what the crypto industry says is, well, the banks, the status quo will prevail unless clarity passes. So the banks have an incentive to come to the table and compromise, right? But it's the banks can play the long game, folks.
Oh,
right?
sure.
This is not the only legislative vehicle available to them. They can just slip some amendment into some other bill, right, that closes this loophole, right? A must-pass Defense Authorization Act or something like that, right? So, they can wait this out. All right, Jimmie, let's move on to our next story because, as you mentioned, there's some things that can be undone and some things that are harder to be undone when you don't go through formal rulemaking. The things that are harder to undo are products, right? Product announcements, product launches, right? Because once something is out there sort of in the ecosystem,
hard to pull it back because, it's people are invested in it and, and so then you have investor protection issues, right? So interesting product launch here, Jimmie, or pending product launch. And we've talked about it when it was first sort of made public, which is the NASDAQ partnership with the DTCC, our good friends at DTCC, right? To enable the trading of securities in tokenized forms, right? So they're going to launch this pilot program. The SEC, the news now, Jimmie, is last week the SEC approved this rule change by NASDAQ to enable, tokenized securities as part of this DTC pilot program. So tell us more about the significance of this. Yeah, I mean, I think there's a couple of things that are really significant. One, I mean, it's NASDAQ, and NASDAQ obviously is a huge market that's involved in. I think it's so one of the factors people have to think about in this are the players that are involved. You have NASDAQ, I mean, huge market, second
Yeah.
largest exchange in the world by market cap, and we have DTCC. It is the clearing. So for people who don't, who haven't been paying attention, DTCC is the company that clears all securities in the U.S. and I think about 17 other countries. So this is the way that things are actually done. So it keeps. So I think by doing this, one, NASDAQ stays very relevant. DTCC stays very relevant. The other thing that happens, I think, in this pilot, and what we're going to see is kind of the eligible securities. It's a huge number that they're talking about. And we're talking about the Russell 1000 and all these ETFs that track major indexes.
Exactly.
So it's a really, really, so the while it is a pilot, I mean, the eligible securities are really, really huge. The numbers that we have here. So this is I mean, it's very significant. So you have significant players. You have a significant universe of possible assets that can trade in this. It still says they're going to follow all of the DTCC rules as far as clearing and settlement and those kinds of things. And so, it doesn't go, so nobody has to, change their systems. Nobody has to make, major infrastructure changes or anything like that to do this. And so I go back to, what I said before. Now, the universe they've stated is this universe, right? But how hard would it be to say, private securities that we tokenize, we're going to allow that too, and thereby, and we've talked about it before, basically say IPOs are maybe become a thing of the past, and this is the new way to bring securities public. I mean, we've had different kinds of auctions and things like that, but they're very, very one-off. This could be a way to, I think, could expand the way that securities are offered out. And it's still going to be under, the guise of NASDAQ. So they still have real rules and things like that they have to follow. But, instead of going through that process, we're now shortchange it. And for issuers, you and I both know, I mean, it saves them a boatload of money.
Yeah. I mean, this is not full on tokenization.
No.
Right. So there are many models. We talked about these models. Let me give some of the key features, Jimmie, and then I want to get your take on, okay, sure. given these features, what is the genuine utility here? Who stands to benefit from this? Okay, so for the DTC pilot with NASDAQ, it's fungible and unified trading. So tokenized securities have to be fungible with their traditional counterparts. They share the same CUSIP number, trading symbol, shareholder rights. Okay. Tokenized shares and traditional shares will trade on the same order book with the same execution priority. Okay. Tokenization instructions. So the way it'll work is DTC eligible participants will indicate a preference to clear and settle trades in tokenized form by selecting a designated flag at order entry. Okay. So then NASDAQ, acting as the agent, communicates those instructions to DTC on a post-trade basis. I think then DTC sort of basically locks the sort of traditional security up, issues a token, right, on a blockchain that I think they're running. Yeah. And then regulatory consistency. Okay, so the tokenized shares will follow the same procedures, regardless of again as same procedures as traditional. Okay, all existing order types, routing strategies, and fee schedules remain unchanged. Market data feeds will not distinguish between tokenized and traditional shares. And importantly here, Jimmie, trades will continue to settle on a T+1 basis. Yep. Okay. So, some limitations here. I mean, I think, look, the main takeaway is that NASDAQ working with DTC is demonstrating that no substantive rule changes are needed to allow tokenized securities in a fungible manner with traditional securities. But are they leaving certain benefits on the table, given the structure? And what are they, Jimmie?
I think there are, some significant ones. I mean, we all know that one of the advantages of blockchain is that it's immediate, that everything happens. And now we're basically saying, we're going to put a circuit breaker in there, right? But to me, that's one of the biggest ones is you don't get real 24/7 trading because you still have to wait a day to clear and settle everything. To me, that's like really, really significant that that's happening. I think the other thing in there that is, we'll wait and see kind of how it manifests itself, is it's still representative of an underlying asset. And how is that going to be treated for capital purposes? So is it going to what's going to look like on your balance sheet? And this is really important. Is it going to be a security on your balance sheet, or is it going to be a representation of a security on your balance sheet? And that makes a difference on a lot of lending and collateral, and even your margin account. How do those things get treated? If you start using derivatives, can you map that directly to a derivative? So in other words, if I own a tokenized version of Apple, all right, and I want to sell some call options on it, are they going to be able to map those directly? So when I get called away, I don't all of a sudden get a big freaking bill. I just get my stock called away. I mean, those kinds of things seem like, oh wait, there's a way out there. But I mean, look and see how much is actually traded and how many things like that are done. And all of a sudden, I have some questions around that. But to me, the big one is, this is kind of a cool thing and all, but to what end? I mean, it seems like the biggest advantage was being able to do this in real time, and that's not happening.
Yeah, that's why I wanted to ask you. So it's neat, I guess, but and I have to go back. I know we talked about it when they announced it, and so so maybe we came up with some ideas back then, but it's not entirely clear to me like what the benefits are of this. And that brings us to the next story, Jimmie. It's a really interesting article from CoinDesk, and I want to get your thoughts on this. And you kind of teed it up a little bit about who stands to gain and lose from this push towards tokenization, which we talk about every single week, right?
Yeah.
And so the article, is talking to someone, I think, from TD Securities, the vice president of U.S. equity market structure at TD Securities, and he raises a number of good points. This is what I thought were good points, and as someone who has worked in the institutional trading space, would love to get your thoughts on this, Jimmie. So as you mentioned, right, one of the main benefits of tokenization is allowing securities to move and settle instantly 24/7. Okay. But the point that he makes, an article makes, is that for many institutional traders, right, that's not something that's all that desirable, right? For reasons around liquidity and financing. So if you have instant settlement 24/7, that means that you have to pre-fund all your trades, right? And so the current system where stocks are settled on a T+1 basis, right? That allows brokers and trading firms to net positions and manage funding throughout the day, right? And as I said, instant settlement would, by contrast, require transactions to be fully funded before they occur.
Right.
So then you have to think about funding costs and where you're going to get the funding and whatnot. And he goes on to say that, look, the main beneficiaries or the main sort of demand driver for this will probably be overseas retail, right? Who can't access U.S. markets when they're open, right? And he says at the end of the day, right, institutional investors will go to where the liquidity is. And so if that's where liquidity migrates, then they will follow, but there's still going to be friction. So just talk about this, Jimmie, given your experience in this space and sort of some of the challenges. So we talk a lot about the benefits, and you've been, arguably as long as anyone talking about the benefits of tokenization. But for institutional investors, some challenges, right?
There are definitely some challenges. Probably the biggest one is the liquidity. Institutions can't really operate in an environment that isn't terribly liquid. And so, and as anybody know who's ever tried to trade stuff outside of traditional market hours, which, I mean, a lot of things trade now, the liquidity is not great. At times you can have, pretty big spreads. You can just not have very deep markets. Now, as it gets busier, as we have more and more people from around the world or retail investors who want to trade 24/7, I think it will get better. The big wholesalers will make sure that it's better and that it can meet the demand. But for institutions in particular, this is going to be problematic. The other part is for institutions is, when do you say it's the end of the day? Somebody has to say it's the end of the day. And how do you mark things, and when do you mark them? All of a sudden, I mean, because so for right now, for funds, for instance, like mutual funds and things like that, right? You mark everything at the end of the day, then you trade at that mark price, that NAV. Well, how do you do it when there's not when there is no end of the day? do you just, is somebody going to say, okay, no, 5 p.m. is in New York, it's still going to be the end of the day for NAVs? Sure, we can do that, but
Yeah.
everybody knows it's not real. And so I think there'll be, you'll see some game playing and things like that go on. I mean, we've
Okay.
already seen a huge migration in the past probably 5 to 7 years of volume. So, if for people who are interested, I mean, you can go and pull up volume charts from all sorts of places, public information. But if you look at volume now, there's about probably, I'm just guessing a little bit, 10 to 15% of the day's volume is at the open. And then another
Yeah.
probably 50% to 60% is at the day's close. And in between, nothing. I mean, it's really, really flat because so many people want to mark things on the close or mark things on the open that, you have this skewness that is pushing everything to the beginning and the end of the day. What happens now? And so I can see that the financing that you bring up is definitely another element. I think people don't realize that that time, that extra day, allows for people to line up financing for cross collateralization and things like that. All of a sudden, you have this market where you don't have an ending. I think it's going to be a lot harder for places to actually watch the value of collateral and how that collateral changes during the day. And for all investors of all stripes, anybody who is involved in using using collateral to securitize different positions, I think it's going to get much more active. I think it's there's the chance that people start getting margin calls in the middle of the night, things like that. Positions liquidated and they didn't even know because the market moved in a huge way.
Yeah. No, great. So how does this all get worked out then?
I think what we'll have is we'll have books that the big wholesalers, the Citadels and Virtus and Two Sigmas and all those guys will operate with more robustly 24 hours a day. I think that's probably is going to be the start. I mean, they operate 24 hours a day now, but I think they'll have to move into a different speed to make sure that spreads aren't too big, that there's some depth of market. Those kinds of things exist.
Yeah, it's going to be an evolution for sure, and it's not going to be the last time we talk about this. Okay, final story of the day, Jimmie. A big transaction. Just want to get your quick thoughts on it. Mastercard, right? We all know Mastercard. Okay, they have announced a $1.8 billion acquisition of BVNK, which I have to admit was a company I was not previously familiar with. Okay. And so for folks who are like me, BVNK is a fintech company that builds enterprise-grade stablecoin payments infrastructure that allows businesses, right, to sort of move money globally, and it acts as sort of the bridge between fiat currency and blockchain-based stablecoins. So it's all about sort of integrating stablecoins, I think, into sort of existing card-based payment rails. Is sort of the sense that I got. I mean, obviously, this is a huge deal. I forget what when Stripe bought Bridge, I think that was like $1 billion. So I think this is bigger than that Bridge acquisition, if I'm not mistaken there, Jimmie. I mean, another sign of the times, right?
Yeah. I mean, one of the biggest issues that you hear about with anybody who's in the digital asset space are rails or off ramps, right? And the two card providers, Mastercard, Visa. I mean, these are the ultimate in payment rails, right? They own the space for the most part. Yes, there are some other card providers out there, and I'm sure they're all nice people, and they all have their own rails, but it's not like Visa and Mastercard. I mean, these are global. They're huge. They are, they have great uptime and those kinds of things. This is what people have been waiting for. I mean, you said it earlier. But are payments being made? Well, now we're getting to that point where payments are going to be much easier to make in stablecoins. And I really do think, I've seen a couple of advertisements, and for the life of me, it's Wealthfront. Wealthfront has been advertising this idea of, keeping your money in an account that earns money market fund type rates. People are starting, and that's what they're advertising. Hey, if you use Wealthfront, you can do this, which is great. I'm glad that they're doing it. I'm glad they're offering that to customers. I look at my savings account at banks, and I think it's still paying 2 basis points or something.
Yeah.
But if you have the ability to put all of your cash, your extra cash that isn't earning anything, into an asset that is yielding something, whether it's a stable coin or something else, and all of a sudden you can use that asset just like cash. So basically, you have a money market fund that you can use like cash. I think this is a really good move by Mastercard to jump in on this. And if it kind of matures like I expect it to, I think what we're going to see is what people have been afraid of, is a lot of assets going into money market fund type accounts, regardless of what they're called, and that will be the cash that people use. It will not be just sitting in checking accounts.
Yeah, I mean, to me, this is all about sort of abstracting away the technical complexity of using blockchain, right?
Yep.
I've mentioned before, consumer payment behavior in the US is very sticky. We like our cards, right? We like Apple Pay, Google Pay, Samsung Pay, whatever it is. That is not behaving. But all I care about is when I swipe my card, I get the good. I get my coffee, I get whatever, right? Whatever happens after that, I don't care, and so if I'm still using my MasterCard, but on the back end, right, there's, a stable coin moving from one digital wallet to another, and that's better, that's cheaper, faster, more efficient, then so be it.
Yep.
Right. And I think this is all about trying to make that a reality. Whether or not they're successful, time will tell. Right. But it's sort of, again, abstracting away the technical complexity for both the merchants and the end consumer. Right?
Yeah. I think you're right. I've always told people that, I always have students inventing new things and looking at launching new products and things like that. It's like, the secret, the success is make it easier. Just make it easier. If you can make something easier, people will actually pay a premium to make it easier. Don't make it harder, because if you make it harder, more steps, anything like that, people just aren't going to use it. People are lazy, and that's not going to happen. But if you make it easier and they can, facilitate things in, better than they could before, people will cling on to it. I mean, we've seen it time and time again.
That's right.
I think this is going to be another one of those examples.
All right. Well, we'll end with people are lazy. All right. But not us. Not us.
We are always on the move.
Always on the move, always trying to stay abreast and keep you informed, our lovely, loyal listeners. And so look forward to doing this again, Jimmie, on Friday. I guess I plan on Friday.
Friday, we are there on Friday. I will not be on the road again.
All right, brother. Talk to you soon.
All right. Have a good week.